Thank you very much, Ambassador Campbell. Now I would like to invite the first panel to come on the stage and to jump into the summit itself. Economic and finance.
Okay. So that's working fine, yeah? Great, okay. Thank you very much, Ambassador, for that introduction. More Canada seems to be a theme. I'm British, you may detect from my accent, so like Canada, I now come from a third country. Whether we're seeking better relations with the EU or not is a bit up in the air at the moment, but I'm sure we'll get there in the end. So I cover trade, health, agriculture, and sometimes energy here in Brussels for the Financial Times. So obviously a lot of the topics on the agenda today are of interest. I've been here for a year and I'm enjoying it, so I've said to my boss that I'm not leaving till CESA's ratified. So hopefully then, you know, might be sooner than we think. So I'd just like to thank our panel today. We're starting with the where the ambassador left off, really, on a more sort of dangerous and difficult world. And we have three people to help us navigate that. Côme de Bagneux from Desjardins, he's manager of business services at the Financial Services Group, Canadian group. Chris de Sutter, head of private banking at Degroof Petercam in Luxembourg. And Jean-Pierre Vidal, who is the chief economic advisor to Charles Michel, the president of the European Council. So we'll probably start with you, Jean-Pierre. Obviously, we have, you know, high inflation, an energy crisis, which is still not past us, and may last into next year. How do you think Europe is handling this, and you know, what sort of policies might be required to you know, keep the employment that we have and keep businesses in business? Thanks.
So, I mean, first of all, let me stress one point, is that last year, at the end of 2021, we were extremely happy with the outcome of the management of the COVID-19 crisis in Europe. And it was kind of a very strong recovery. And in fact, in a sense, we were relieved because this was quite a challenge. And things turned completely, you know, differently in February, as soon as Russia essentially invaded Ukraine. And I think it's important to have that in the background, because the magnitude of the change is quite dramatic, you know. And I just want to quote two numbers on these. Last November, the Commission forecast pointed to growth for 2022 of 4.3% and inflation 2.5, right? Not bad, I would say. Now take the Commission forecast in July 2022, so about six months later. Growth 2.7, inflation 7.6. So it's quite a dramatic change. It's quite a dramatic change in the economic outlook. And of course, I mean, we are confronted with a crisis that is fairly different from what we were confronted with the COVID-19 crisis. The COVID-19 crisis, I mean, was managed very well, but was actually also very much policy-driven. It was a conscious decision to protect the people or to shut down the economy. And then there was an expectation that at some point we will go back to normal, so switch on the economy again. Here we are confronted with a totally different type of shocks. That's basically a terms of trade shock, which makes Europe poor, much poorer than it was. I mean, the magnitude of the term of trade shock is very, very large and certainly comparable or even more than what we experienced in the 70s with our price shock. I mean, the price of some commodities and gas prices, I mean, at some point were multiplied by about 10 times, you know, and so this is something you have to adjust to. And this causes, of course, I mean, several types of problems. I mean, first one is that there is a competitiveness issue for Europe, for European businesses, which faces energy prices that are way higher than other continents, and in particular North America, US, Canada. So there is a need, there will be a need to do something for them, and it's also a shock for households that see their energy bills, shot up to the sky, and that basically have a very negative real income shock. Also through inflation, but inflation is essentially driven actually by energy prices. So what does it require? The good thing is that we already had, taken very bold decision in the context of the COVID-19 crisis. So this recovery and resilience facility, that has had, to my view, during the COVID-19 crisis, a very, very strong confidence effect, allowing member states to let automatic fiscal stabilizer play. Now, is being rolled out in terms of money going to member states in the context of their recovery plan. So that's a first support. Then it is clear also that one has to adapt your way of living. Demand reduction of energy, will be essential. Whatever we cannot live as, or we cannot consider that as business as usual. We will have to adapt our behavior, so behavioral changes will be important. What will it require in terms of macroeconomic policy? I think there are two things that are important, and it's all, to my view, in the direction of protecting our capital, protecting our assets. So in the short term, we will have to support, companies, the context of, for example, the temporary stated framework will allow member states to support businesses. Member states will also support households, partly, and there the measures will have to be targeted, and there is a strong call by leaders for policy coordination, to have a united response to this crisis. And the second thing that is even more important is that while protecting capital and also human capital in the short term, we will also need to build a bridge to a new, in fact, in a sense, a new growth model, a new way of living. So basically, a cleaner, greener economic model. So, basically also adapting our energy sources. So this will be, kind of a two-pronged strategy. Protecting the short term while building the long term. And I think we are in the process of doing it, bits by bits. It's leaders-driven. There are European Council conclusions. The Commission comes with proposals, and the policy discussion will continue in the coming months. Thank you.
Thanks very much. To the two guys in business on the panel, how does it feel to you, and what sort of support can individuals and businesses get from banks who must themselves be, under pressure?
Well, banks have a very, very big role to play, obviously. Just to come back a little bit on the circumstances and the background, we do expect like many people, a moderate recession next year. Hopefully it won't happen, but it has advantages. So what we are going to do and what banks need to do is to keep on helping SMEs, because obviously large corporates, it's a bit like Lucida. Large corporates can always go through crisis, can always go internationally without free trade, but SMEs cannot. And we've got to understand that, because it's not what we hear in many places. Banks really need to focus more on SMEs, and that's not just words. That's what we are trying to do, and I'm not saying we succeed all the time, but we definitely need to do that. I had a Canadian corporate coming once again, an SME coming once again in Europe. And banks are really, really shy on welcoming them. Why? Why? It's Canada. It's not, some politically problematic country somewhere in the world. It's Canada. We have a free trade agreement that's into force. So I don't really see the reason, and I think we really need to push investment, particularly in Europe, I'm sorry to say. So I'm working for a Canadian bank, so it's maybe easy to see the other partner as the bad guy and us as the good guy. It's not always the case. We, Desjardins and Canadian banks, can do better and faster, because also SMEs need to go fast. So better in our processes, better in many, many places. But we need to take a little bit more risk. And I want to be very cautious about what I'm saying, because when banks take risk, we know what happens next. But it's just about knowing each other. If you read at CEDA, the investment part is quite small. And we need to, to develop that, to see what it means to ease investments between Canada and Europe. And we don't know it yet, but we should. And what SMEs are waiting for is, once again, an easy process, a bit more risk, and a bit more knowledge, economical knowledge, market knowledge of each country. We don't know each other so much yet. I mean, sometimes I come with a European company going to Canada, which has a 3 billion turnover. Nobody knows them in Canada. So obviously banks go backward. We don't know them, we don't want to finance that. The same happens with Canadian companies coming to EU. So we need to definitely know each other better, maybe, exchange of more information about corporates, trying to find solutions, especially on the KYC part, for instance. It's definitely taking too much time for SMEs. You were talking about SMEs. It's taking way too much time. A Canadian SME is a reliable partner unless something special has happened, but generally speaking, it's a reliable partner. So it should go as fast as, let's say, USA. And I'm sorry to say that Americans' company can go much faster and an easier way than Canadian ones. We need to go, I think, at the same level of knowledge of Canada, of course, investments in Europe, but also in the other way around.
Yeah, I'd like to go back a little bit on why inflation soared that much in the Eurozone. Obviously, the Russian invasion of Ukraine was the cherry on the cake, but gas prices, if you remember well, they started to increase a lot in October last year. Because of the weather, it was not a lot of wind in Europe, and we had not enough production from sustainable. So we needed to import more alternative sources of energy, and gas was one of the one. So today, if we look at inflation in the Eurozone, around half of the 10% inflation is due to the energy part. If you add the food to the inflation, it explains 2/3 of the prices, of the rise of the prices. And this has a lot of consequences for the consumer. Why? Because wage growth is not high enough to offset the rise of inflation. So the hit to purchasing power is the biggest we have never seen. For instance, in Italy, inflation is at 12.9%, wage growth is only 1.5%. So it's a big loss of purchasing power, which will probably lead to a contraction in demand at the Eurozone as a whole. Let's not also forget that there are two types of inflation, goods inflation and services inflation. Goods inflation has been rising during the COVID period, because the US economy was overstimulated. It was, under the Biden administration, the American Rescue Act added 8% of GDP of help to households at a time when employment gained back to the previous level. And so it was an overstimulation of the US economy. People during COVID didn't buy services, they bought goods, mostly TVs, iPhones. They were mostly coming from Asia. And therefore, the demand for goods increased a lot during this COVID period. Shipments cost also increased a lot. And today, all of this is being reversed. But on the other hand, we have this energy part that makes inflation rise a lot in the Eurozone, which has become an issue. I want to stress another point, is that we know that we've been in this situation of rising energy prices for about a year now. And I must say, sadly, that most of the response so far have been taken by the Eurozone countries separately. The European Commission has been discussing some help to households for about a year, but there has not been some concrete on the table. And this, we should work on this, because it's at the end of the day, the cohesion of the Eurozone that is into play. I think it's important to remind it. We need more Europe and also more powerful Europe, and this is important to remember.
Yeah, I mean, Jean-Pierre, we've been talking, I guess, about a Shore-style scheme, which was a Europe-wide scheme that was used under COVID. Some member states want it, as ever, some don't. I mean, do you see how likely do you think there will be a unified response, or will it be more country by country? And if I'm a business and I'm being cold-blooded about it, I might say, right, I will invest in this country because, they have the resources to survive, and I will pull out or reduce my operations in, say, Italy, because, it's suffering more.
No, I mean, these are very good points. I mean, one thing one has to realize about Europe is that Europe is not yet a federation. So when we talk about the budgetary power, in fact, the power lies in member states' budget. I mean, the union budget is very small in comparison to our member states' budget. So, in fact, I mean, one thing that is extremely important, and that relates, in fact, to your point about the level playing field in the single market, is that policies are well coordinated. And on these, I mean, there is a strong kind of guidance by the leaders for policy coordination, for more policy coordination. And that's being discussed at the level of the Council or for the Eurozone at the level of the Eurogroup. Of course, in the situation in which we are, I mean, there is, for example, an agreement, I mean, a political agreement that, measures to mitigate the impact of high energy prices for households on businesses should be targeted, temporary, and so on and so forth. Now, if you look, of course, at the type of measures that have been taken so far, immediately, under emergency, I would say, most of them, I mean, are actually untargeted. But this doesn't mean that it will not change, because there is a political consensus in this direction. The point is that, of course, it's very difficult. And when you have, the pressures, the immediate pressures, and we have seen that during summer, for example, I mean, you had kind of subsidies for oil, for petrol, and so on and so forth, that were kind of blanket subsidies. So I think this policy coordination is there. There is an agreement on that, and it will be set in or phased in, gradually over the coming months, to be honest. And that's the way it is. Then there is what we can do at union level, and then it's a policy, I mean, it's a political debate on how to use, or to revamp the instrument that we already have. For example, the remaining 225 billions of loan that have not been requested by member state under the Recovery and Resilience Facility, and that are part of Repower EU and still being discussed. And actually, I mean, this is also something that is one of the levers that can also help member states. And then there is a political discussion on that. And then the debate remains open. So in a sense, I mean, that, there is an openness to discuss common European level solutions. Now, whether it's for tomorrow or that's another question. But I mean, this political discussion at European level is kind of permanent, and there are many issues that have to be solved, at the same time. And I must say, during the first, the first half or so of this year, I mean, the priority was very much on energy, what to do with energy and the energy discussion. And now, I mean, we are turning more to the economic discussion. In fact, the macroeconomic discussion. And that's, in fact, I mean, is being put in place gradually. But I think, by and large, we are on a good track. And we also have a fairly good track record, in fact, in terms of crisis management. with significant improvements over time. So I think one has to be optimistic, but one has also to be aware that this crisis is a very serious one, and that there is no magic wand, no simple solution in the short term, and that one will have to work on several levels in terms of short-term response, as I said, to preserve the asset, to preserve capital, and then build the future. And that this future, what is good, in a sense that we already had a political agreement, for example, on the Green Deal. And so that's rather a call to speed up this transition and to do more, and to be also more inventive. And that's where I think the role of the private sector, to be honest, is extremely important, because inventiveness, to my view, very much is one of the specificities of business people on the private sector, to invent solutions and profitable solutions to problems as they emerge. I mean, the policy makers can just provide the framework for that, in a sense.
Thanks. So, I mean, in terms of the private sector, maybe Côme first. You know, Canadian companies have CETA, yet they have problems accessing the EU market. I mean, do you think, and indeed energy prices are often higher now, so you know, Europe is suffering a bit of a competitive disadvantage. So how should we, you know, what should the role of Canadian private sector be in investing in Europe, and you know, what opportunities are there, do you think, for Canadian businesses to help the economy?
Obviously, whatever is about energy, raw materials can really help Europe, because we're importers of these products. So obviously, CETA is going to be a huge tool in order for us to diversify, because I think that's what we've learned from COVID and now from the war in Ukraine is we need to diversify, and we've got some some shutdowns and some problems with supply chains because we were not diversified enough. And we can talk about oil, we can talk about gas, but we can talk about mustard, we can talk about many products. And once again, maybe we should play more collectively in Europe, I would say. You were saying more Europe, I fully agree with that. And that means also for the private sector. We need, more Airbus. I've just read in the news this morning that maybe in Italy, Vega was going out of Ariane space, and we need to focus on what's important. And Airbus was a great example of what Europe can do, European private sector can do. I would say banks need to be there too, whether it's about inflation. Obviously, we've got to deal with what ECB chooses, but we can also play our part, being inventive, as you were saying. We are very late in terms of venture capital. For instance, we were talking about SMEs, either venture capital or development funds. We're quite late. So maybe you don't see it as a British person, because you were quite advanced and you're still advanced in UK, but continental Europe needs to to catch up with this venture capital and risk capital industry. I see it every day. Canadian companies coming to Europe, they want to raise funds. Most of the time it's going to come from UK or US or Canada, but I would say Canada is not also as active as their American neighbors. So both Canada and Europe can have a part to play, and banks, I'm talking for banks obviously, should maybe create their funds and more funds, to be able to have our Silicon Valley as well, to be able to bring some industries and invest in industries that you feel are strategic. Obviously, the European Union is doing that, but the private sector needs to come in and needs, and serve the policies that are voted either at the European level or at the state level. If Canada wants more industry and manufacturers, they need to have the funds investing in those new manufacturers because they might come from abroad. And if they come from abroad, they'll have no debt, most probably. So they can have capital. If we want more energy, green energy mostly, or more whatever is Canadian, we invest a lot in wind farms, for instance, which Canada has, in which Canada has a real know-how. If we want to do this more, well, if you want to have newcomers in Europe, whether SMEs or large corporates, you need to have capital. So that's really something we need to focus on. Yes, it's risky. Yes, it needs an investment, but the payoff is there, and you can see what UK or US has done in the past. Generally speaking, they've done a great job doing that.
Thanks. So Chris, yeah, I mean, you're obviously a provider of capital. How do you see the landscape? And just going back to your earlier point, is there any relief from this inflation? Do you think that the energy price will eventually wash out, as it were, and next year, at least, inflation might start coming down?
Yeah, about the point of energy inflation, the gas and the oil market remains very, very tight. We are in a situation today in Europe where almost the inventories of gas are almost full at the entrance of the winter. How did we manage to build that inventories without Russian gas from June? It's because we have imported liquefied natural gas mostly from the US. So this was a very important point. So how Canada should help, could help in the short term, it's not obvious, it's quite difficult because most of the gas that Canada produces, it's used internally, and the rest of it being sent to the US. So Canada today doesn't have infrastructure to liquefy natural gas and to send by cargo to Europe. It is working on it. LNG Canada will run from maybe in 2 years' time, but now there is no gas exports capacity from Canada to Europe. So today the situation in the energy markets remained very tight. Total CEO estimated that this year it lacks 100 billion of investment in oil infrastructure to keep current production at the same level. So it is huge. We must not forget that in our energy transition, we should continue, sadly, to invest in dirty fuel. About the oil market in Canada, about 50% of the oil is what we call oil sands. It's very dirty oil. It cannot be used for gasoline, mainly for building roads or for construction. Only 15% of oil that Canada produces is light oil, so it's oil that can be used for gasoline. So it costs a lot to, yeah.
And just on the investment point, I mean, you do asset management and other things, I think, your institution. So where do you see the opportunities to invest and the gaps as well, where more funds are needed, and where could they come from?
So clearly from this crisis, there is a huge opportunity for Europe to invest more in green energy, because we know that other sources of energy or partners are clearly unreliable, and we should take this moment to clearly jump into the future and massively increase our own sources of energy. But keeping in mind that the production of green energy can be volatile, as we saw last autumn, as I explained, that we should still keep part of our energy mix in oil and gas to compensate of the fallout of the green energy should it happen.
Well, we're close to the end of our time, but I did just want to try and look forward a little bit with all three of you, putting Jean-Pierre on the spot. I mean, it's very hard, I guess, with the war in Ukraine. Nobody knows how it could. But what's your sort of scenario for the next, 12 months or so? I mean, how deep and how long-lasting could the recession be, or equally, how may it not be as bad as we fear at the moment?
I mean, I think, having a reliable economic forecast is always very difficult, but at the current juncture is actually extremely challenging, if not impossible. So you can have, you have baseline scenarios, and then if you take baseline scenarios, you will end up, okay, so we are going to recession at the end of the year, beginning of next year, and then it will pick up again afterwards. But the truth is that you don't really know what will happen, what kind of additional shocks you will have into the system. And so you are in a kind of situation where for macroeconomic forecaster, I think it's extremely difficult to say things that are meaningful. Because in fact, kind of a shock like this aggression by Russia is just a 1-0 type of shock. So either you had no shock and then it's business as usual, and then we will be kind of, be very happy to forecast, kind of a strong recovery, or we were happy to forecast a strong recovery. And then suddenly, the world has changed. And now, we are in a world where I think it's difficult to have, this kind of macroeconomic forecast because, I think we are in a world where we are undergoing structural changes, in fact. First, because the world has changed, the geopolitics, the geoeconomic has changed, and at the same time, we are also reacting to it. And that's good, actually, that we are reacting to it. But by reacting to it, we also change things. So, for example, and that's all of us, businesses, households, I'm sure that in businesses, people are quite, considering carefully how to use energy, when to produce, whether they can save on these, on that, whether it's, really necessary to heat the whole factory or whether you can, produce only one part, and these kind of things. And this is what I would say inventivity or innovation in firms. And households will do the same as we used to do in the 70s when you had large houses. Most of the rooms were closed, and then you will not go there during winter times. And I think, this kind of behavioral change is extremely important and will condition very much, the way out to this crisis. So that's what I would say. On inflation, I would tend to think that it's very much energy driven. It's driven by these external, external shocks, by Russia's weaponization of energy, in a sense, or foods. We all know that when you have in the inflation series, this kind of shocks, it vanishes after 12 months, provided there is no second round effects. And so far, when you look at long-term inflation expectation, in particular in the Eurozone, they remain well anchored. And they remain well anchored probably because we have had, an appropriate monetary policy reaction function, in a sense. So maintaining this anchoring of inflation expectation is important. So I think I will tend to think that we are, by and large, reaching the highest inflation numbers in the coming quarter or so, and then it will not vanish immediately, but it should go down also because there are recessionary forces in the economy, in a sense that will also be there. Given the current situation.
So, Bart, do you want to try to, Chris? Do you want to try to have a forecast, or at least
in terms of economic activity, or? Yeah, it's going to be hard for the Eurozone to grow over the next 12 months. If you look at confidence indicators of households' intentions to buy durable goods, it is as low as it has never been. So I don't see consumption growing a lot over the next 12 months. I want to make a point about inflation, that during the last 2 years, it was quite easy for companies to increase their prices. Why? Because demand was strong. Today, we are in an environment where demand is slowing down, and the costs are rising for companies. So it's going to be more difficult for them to pass this cost to their customers, meaning that the pressure on margins will increase. That being said, so we see inflation starting to slow down over the next months. The big risk I see is coming into December. So we know that Russia has used gas against us. It may do the same with oil. If the price cap is decided, Russia said that it will not sell its oil below the price cap, and if it withdraws from the market 2 or 3 million barrels per day, oil prices will again rise, and inflation will continue to rise. So this is the key risk in my scenario of slowing down inflation over the next 12 months if its oil price continues to go higher. But yeah, the outlook is not that great from an economic perspective next year for Europe. I mean.
And Côme, I don't know whether this is a fair question, but I mean, looking at the Canadian economy, for those people in the audience who might be European businesses, I mean, but presumably they're in a better shape, are they, because of the energy question? So.
They are in a better shape, but with our economists, we had in mind that actually raw materials are not so cheap in Canada, and that's one of the major problems Canada faces, or any country that produces raw materials, is that prices are global. So, many people came to me saying, well, lucky Canadians, they're going to buy their fuel much cheaper than we do. Actually, they don't. The price has doubled as well because, it's all global. So, it depends who builds the pipes, who extracts the oils, who refines it. We've seen that in Europe. So definitely, they have the leverage, and that makes the difference. They have the leverage. If they change the regulations, if they put caps, and they can afford to put caps in Canada because they have oil, they have the leverage, to ease a bit the market economy to go to a more regulated economy and face whether it's inflation or the rest. But they believe in free trade, and they want to stay in free trade as much as they can. So they've got to use their central bank. They've got to diversify. And I want to insist on another point, is that that's the main reasons of CETA. Many people, again, came to me that Canada, they want to take our assets. They actually work for the US. I've heard many, many things, all of which are untrue, because what they want is to diversify their economy. They don't want to be dependent on one country, whether it's a friend or not a friend. So basically speaking, we have an economy that's growing faster than Europe, regularly 2, 3, 4% growth per year. So you can expect, our economics expect something between -1 and +1 this year, which is not so bad, and which is expected to be a bit better than the European Union. They also have diversified a lot their economy. Western Canada is still a lot about energy, but it's more and more about manufacturing, and Eastern Canada is a lot about manufacturing. And they have also a bit of raw materials. So it's resilient, definitely an economy that's resilient. Maybe a good time to invest in, and I'm not trying to make any kind of publicity, but as you know, crises make prices cheaper. So when they are cheap, you'd better buy. But definitely we, working closely together is also going to help. We need gas, they have gas. We need some materials, they have ones, and they need our know-how, they need our machines. I'm not going to talk about Germany, they are so well known for making some good machineries, but also aerospace in all Europe. We can help them, we've done a lot, so it's time to continue. So yeah, a decent forecast for 2023, but nothing huge. We'll have to wait for 2024.
Okay, well, on that reasonably positive note, I think we should leave it there, and let's not forget Canada is a G7 country, so if they're growing, that helps the whole world economy. Can we just thank our panel for their great insights and conversation? Thank you very much. And
Thank you so much. Thank you. We'll jump into the next panel. It was very interesting, a nice intro. I like that a lot. Now, another interesting topic, Canada and EU partnerships. So I invite all the conference speakers and the moderator to come on stage. Thank you.